There we go. Control V. And go.
Access to this webinar is for educational and informational purposes only. Consult a licensed broker or registered investment advisor before placing any trades. All securities and orders discussed are tracked and monitored in virtual trading accounts. Virtual account prices and returns may differ from actual trading results. Commission costs are excluded. Neither PhilStockWorld.com PSW, nor its affiliates, nor any of their respective officers, personnel, representatives, agents or independent contractors are in such capacities licensed financial advisors, registered investment advisors or registered broker-dealers. Nothing contained in this webinar, website or promotional material constitutes a promotion, recommendation, solicitation or offer of any particular investment, security or transaction. Trading options involves risk. Visit the OCC website www.optionsclearing.com to read characteristics and risks of standardized options. PSW provides education and training services that are meant to teach you the risks and potential rewards of trading options, and we are not the service that tells you what to trade. We are not implying or guaranteeing any profit. As always, do not trade with money that you cannot afford to lose. Past performance does not equal future results, and results discussed in this webinar are not typical and are only valid on that specific or identified date. Your results may vary. By accessing this webinar, you agree to hold the above harmless from any losses you may incur as a result of information discussed in the media identified above. By accessing this webinar, you agree to be placed on our mailing list and receive our newsletter. Rest assured, we take your privacy very seriously and we will not distribute or sell your information to anyone.
Except Facebook. They get everything. All right. Wow. Okay, this is happening again during the week ending June 15th. Today, oh wait, today's the 20th. Is that right? Yeah, okay, mate, this is the current one. I'm sorry. This is actually correct. No, wait. It can't be the next week. U.S. commercial crude inventories decreased by 5.9 million barrels. That's not what we got before. What's going on? Guys, am I crazy? June 15th was Friday. Why would it be to Friday? That's not how it usually is. This is so weird. Am I crazy? I feel like I'm crazy. Commercial inventories decreased by 5.9 million barrels. Yet, earlier today, oh, it was 5.9. Sorry, I was thinking of the net number, which was 5.9 plus 5 plus 6 is flat. So okay, my bad. It is the right numbers. All right. So commercial crude down 5.9 million barrels, and then motor gasoline increased 3.3, and distillates increased 2.7. So you got to think about it. The refinery makes the oil, right? So if they increase, I'm sorry, the crude decreased. If they take in 6 million barrels of oil and they output 6 million barrels of distillate and gasoline, then nothing changed. It's the net number that matters, okay? There's no net draw from the refineries. They still got the same amount of oil that they started with. They just changed it into something else. Now, what's wacky is when they start shipping it out of the country, and notice they increase their exports by 250,000 barrels a day. That's not nothing. It's almost 2 million barrels a week. So they increased exports by 2 million barrels a week, basically. And they decreased, see this also, see 141.6141 went down to 6005. So we had 141 per day less imports. That's a million barrels less were imported. So bullshit on anybody tells you there's demand increases. 1 million less barrels being imported, and 2 million more barrels, not 2 million barrels, 2 million more barrels are being shipped out of the country than there were last week. And even with that, our inventories are flat. See this number? 18681, 18682. Actually, we had a net build of a 1/10 of a barrel there. And that's why? Because of all other oils come out of a barrel. this is not a bullish report at all. This is not a report that shows demand at all. And OPEC is meeting on Friday under the premise that demand has increased and so they will increase production. What the real truth is demand hasn't actually increased, but it looks like it increased, and it gives them an excuse to sell 1 million more barrels of oil for $60 a day, which is $60 million a day, which is $1.8 billion a month of additional revenue for mostly Saudi Arabia. And nobody is that rich that they don't want to get an extra $1 billion a month. Okay, and nobody, even Jeff Bezos, when you say would you like to make another $1 billion a month, is like, hey, I'm kind of interested in that. Okay, it's a lot of money. I know it's funny how we talk about all these huge numbers all the time, but that, $1 billion is still a lot of money. Hard to make $1 billion, and OPEC makes it by just turning on the taps. And again, there's an overriding issue with OPEC that down the road, a certain percentage of their oil, which is an asset technically, is never going to come out of the ground. That the world will turn electric faster than they can use up all their oil. So anything they don't sell is a wasted asset. And the Saudis understand that, and the Russians understand that. Iran doesn't seem to understand that, or Iran hates us so much that they would rather not make as much money as long as it hurts America. So I think Iran's got a different issue. Now, of course, don't forget we have sanctions on Iran, and we're making their lives miserable. So anything they can do to make our lives miserable, they want in on. That's our new diplomacy now. It's it's one-upping each other. Is our new form of diplomacy. It's very unhealthy. Anyway, all right. So that's the oil situation. So nothing surprising there. And of course, also it's the last day of trading the July contracts, and there were a decent amount of July contracts open, and so it wasn't surprising at all that oil, because of the report, took a bit of a dive today. Nothing tremendous. Let's look at the hourly chart. So, this morning I said we should short oil at 66 line, and it came down, tested 65, probably settled down around 65 too. Right now it's coming back to 65.50 though. So it's just bouncing around in here, but basically, the report was what we thought it would be, and then oil sold off. That was a very easy one to call. I wouldn't have expected gasoline to drop so much. That's kind of surprising, but they had a build, and people are very put off by that too. And all these new cars, every time, even though a lot of people are buying trucks, the new trucks get way better mileage than the old trucks. So that's the demand problem that they face on gasoline. It's like the new cars just don't use as much gas to go the same amount. People aren't physically driving more miles. They're driving the same amount of miles in cars that get better mileage, therefore using less gas. And a global problem faced by the industry. People just aren't using it like they used to. We're using more natural gas for other stuff too. So oil is getting squeezed in a couple of ways, and if it wasn't for the July 4th weekend, I'd be shorting the crap out of it right now. 65 is way too high, and after July 4th, I mean, if it goes up to 70 into July 4th, I want to short oil anyway. I don't care. 70 is just ridiculous. Even 68.50, I think I'll probably start adding some shorts, or maybe pick up an SCO, which is an ultra short on oil. Is it SCO that's ultra short, or is it long? I don't remember, but let's find out. SCO. SCO is ultra short. Okay, so in other words, if oil goes up and SCO gets pushed back down around 16, 17, whatever, I would be very happy taking a long spread on SCO. That's the ultra short on oil, because then I can ride out July 4th. It's not going to matter much. In fact, here's last July. See, here's July, May, June, July. See that doesn't prove anything. I'm sorry. Wow, weird. That proves the exact opposite of what I'm trying to say. SCO is ultra short oil. Yes, it is. And what happened last year? I'm mixed up. Did we take off after July? Oh, we did. I didn't realize that. So we had a little. We took off. All right. So what I'm saying is doesn't sound right because last year we happened to actually go up and up from July 4th. We had a crash into July 4th, picked up on the holiday, sold back off, but then things just started taking off, and that was all the OPEC, BS and all the stuff they're doing. That's gonna, I think, start to fall apart this week. And since wait basically all year long, went up, came back down hard, went up, came back down hard, and now we're still back basically where we were in January, just a little bit higher. But after the summer driving season is over, what's the catalyst going to be to keep oil up? This was too low. We knew that. The $45 is too low. 50, 55 is the right range for oil. 57.50 maybe, but not 65. It's too high. All right. Let's see if there's any questions. Questions. Okay. Good. No questions. Right. Yes, I've saved my voice. I don't know how long it'll last. I can already feel it. It's like not good. What are we doing? All right, let's take a look at the current situation. Can't move that. Can't move that. Why can't I move the screen? Must be some way it moves. Unbelievable. I can't move the frickin' thing. Oh, here it comes. All right. As usual, because it's Wednesday, I'm down a couple of $1,000s on my Nasdaq shorts. I said earlier to do tight stops over 73.03. But of course, since I'm busy doing all these other things, I wasn't paying attention. It went up to here. And so instead of doing tight stops, I said, oh, screw it. And I just added some more, which is, I kind of almost always end up doing that on a Wednesday. And now I got to wait for it to come back down. So my average is 73.09. So when it comes back to 73.10, which is a realistic target over here, then I'll lighten back up to maybe 4, and I'll have a nice high entry, and then hopefully we can get a nice run down. If I get the run down, I expect long term to 60. These are now September contracts too. If I get the big run, I expect all the way down to 6,500 at 4 contracts. That's $80 times let's say 6, 7, 800. So 800 times 80 is what? $6,400. Is that right? Sounds like not enough. Wait a minute. No, it's like 64. Wait. 800. Yeah, it's bigger. 800 times 80. $64,000. Okay, so that's what I'm hoping to make. I'm trying to make $64,000 shorting the Nasdaq from here to 6,500. That's my basic goal. Whether it happens or not, I don't know, but it'll be fun if it does. All right, and if that happens, both my daughters will get cars this year, so that'll be nice. All right, anywho, so you don't wish for these things, but that's nice to think about if we can get it. If I can get both cars for $4,000 investment, that's worth it. Let's see. As it is now, oil's popping up a little bit, and we'll take a look at what everything else is doing. Charts. The S&P 2780 is still a problem. See 2780 here, we topped out. So we're just testing it again here. The Dow is much lower than the other indexes. The Nasdaq has busted over its thing, but again, it busted over it last week too, so we're not that impressed. And the Russell 4 change is selling off. Very, very weak all of a sudden. So we'll see what's happening there. That's interesting. Wait, something wrong with this chart. RTY. I might be wrong. Nah, what the hell? Thinkorswim, I think, randomly stopped showing TF again. Isn't that weird? Yeah. That's old. That's a useless chart. RTY. So be careful not to use the TF chart for the Russell. It's RTY is the current chart. So the Russell is still up in La La Land too. So the question is it Dow being realistic or not? The NYSE is our deal breaker. That's what we've been watching. So look at the NYSE. And it's 12,664, 12,800. And let's get back to today's post. Oh, you can see. Actually, you know what? You can probably see on this thing better. We don't need the lines. But 12.8 right here, that's our must-hold line on the NYSE. Anything below 12.8 is not good. This is where all the stocks are. So all stocks, basically, I mean, there are some that are on the Nasdaq and not the NYSE, but all stocks are here. In fact, the ones on the Nasdaq, there's a lot of overpriced, bullshit momentum stocks on the Nasdaq. So all stocks that aren't trading at 100 times multiples for no reason are on the NYSE. And we're talking about, I'm sorry, there's the Russell also. There are Russell stocks, the small caps, not on the NYSE. They're testing the 50-day moving average, but you see, this is the most important thing. They're testing the 50-day moving average. They're consolidating for a breakdown. They had to move down from 12.9 to 12,650. That's the 50-day moving average, right? 12,650, all the no's. Okay. So 9 to 650 is 250. So 20% of 250 is 50. So the bounces from 650 would be 12.7 is weak, and 12.750 would be a strong bounce up here. We never made the strong bounce. We consolidated on the weak bounce and then failed hard, overshooting to the downside by almost 100 points. Overshooting this line by 100 points. That is and then we come back and we're not even able to make a weak bounce. This is a downtrending pattern. This is very, very likely that we're only just testing that for the first time. We're going to be back here very soon. And that's a failure of the 50 and the 200-day moving average. And once you're below the 200-day moving average, the 50-day does not have very far to go before it's back in the situation, almost making a death cross. This is what happened a month ago, and now it's kind of happening again. This is what happened 2 months ago, and now it's kind of happening again. It's what happened 3 months ago, except the problem is, here you go, see how it gets rescued every time, right? This dragged down very quickly and then got saved, dragged down very quickly, got saved, dragged down very quickly, got saved. Hasn't even started going down yet. Not sure they're going to be able to save this one. So we'll see, but look, this should be very concerning. This is a broad market index. It's failing its major averages. So that's what I'm watching closely, and I'm not going to jump and run into bullish plays while that's down there. So Sri says, Phil, any idea on where to put cash on the sidelines? CDs, I have no experience with bonds. At these rates, I just let I just let TD sweep the money into their overnight account. I think they pay like 1.5% or something, or 1.75%. Talk to those people, because then the cash is still in your portfolio. So like every night they put it into a account. And so any unused cash goes in and collects interest overnight. Then it goes back to your account during the day. So you get like half of that interest. That sounds bad, except the interest is nothing. It's not a thing. Or let's get more practical, right? Let's say you have $200,000 in cash. All right. How much is 5% interest on $200,000? That's going to be $10,000, right? So you could put the $200,000 in a bank and have absolutely no chance of doing anything else with it, or into a CD. You get 3%. Forget 5%. You get 3%. But in reality, there are way better things to do with your money. So let's talk about a couple of things. This is a good lesson. I'll close this up. So let's take good old AT&T. Oops, sorry. So we look at AT&T. And AT&T is $32. They're always $32. They've been $32 for like 10 years. Let's see if I don't have that kind of chart. Yes, I do. Okay. Chart. And we're really looking for T. Okay. Why are you doing this? Stop that. Stop. Okay, there. Max. All right. Since 2002. All right, well, it's more than 5 years, so. Can I change that range? No, I can't. Okay. So since 2002, AT&T has been, or actually, I'm sorry, since 2003 when it stabilized a bit more, it's been between 23 and 27. So it's a $4 trading range. Obviously they're probably here to stay. It's not likely to have any violent upheavals. I mean, frankly, no more so certainly than the bank you're going to put your money into. It's not more likely to go bankrupt than the bank you've got your money in. So clearly we could use them to see about getting some interest. Now, the stock pays a 6% $2 dividend. Already, it's much more than you're going to get from a bond. But the point is not to tie up all your money. So what I'm saying you can do, instead of owning the stock at all, you can promise to buy it. It's $32. You promise to buy it for $30, and you will get $3. You can go $2.94, but let's say $3. So you sell the puts for $3. Your net entry on AT&T is 27. So let's say that you promise to buy, and I'm going to do it right now. Let's say you promise to buy, not buy, sorry, sell. You're going to sell and you want to, 200,000 we said, right? And you're looking to get $6,000. So let's promise to buy 2,000 shares of AT&T. So we're going to sell 20 puts. And we're going to collect $6,000 for $3. All right, so we're going to collect $6,000 right now. And look at my buying power effect, my margin, $5,000. $5,500, let's say. So I'm going to collect $6,000, and I'm going to use up $5,500 of my $200,000 in buying power. Or actually, if you have cash and you're in a proper account, you're going to have $400,000 at least in buying power. Using just $5,500 of that buying power, you're going to collect $6,000 for promising to buy AT&T for $27. That's $5. It's a 15% discount to where it is now. And now you've collected 3% interest on your $200,000 on day one. If you do that, like we do in our long-term portfolio, if you do that once a quarter, so in other words, you're not going to overexpose yourself. Once a quarter, you're going to pick another stock that's very stable, All right. So let's say we go with McDonald's. I'm not saying get McDonald's now, it's kind of expensive, but or Disney. Disney's not expensive. Disney's reasonable. Disney, 107. At 100, I like to buy Disney, not 107. But still, with Disney, I sell some 95 puts for $5. So Disney's at 107. It's $20 below the current price. So it's, again, a 15% discount. I sell 10 of those. All right? And if I sell 10 of those, which is the default for $5, then next quarter I'm going to collect $5,000, and I'm going to have $7,000 in margin taken out of $400,000. But now I've collected $11,000 against my $200,000. I've used $10,000 in margin, nothing, and now I've basically already gotten back 5% interest for the year, and I've gotten paid ahead of time in 2 quarters. I can do it again the next quarter and the next quarter, and obviously I'm only doing the next quarter if the first ones are going well. If anything goes wrong, if the market drops, I will change my plan. But as long as the market keeps going up and I want to make my interest, I just sell another put and sell another put in proportion to what I have. And don't forget that as you sell one put, the other puts deteriorate and they start losing their value, which is good for you. You sold it, you didn't buy it. So they start losing their value and you have less to pay off when it comes time. And eventually, if the market stays up, they go to zero. If the market doesn't stay up, you might take a small hit and you get out of the thing, or you end up owning the stock, which isn't a tragedy to own dividend payers like AT&T or McDonald's or Disney at 15% discounts. This is how we set up all of our long-term portfolio plays. We often, not all of them, but we often start by selling a put. We're always looking for puts to sell. If I'm interested in a stock and I feel it got beat up a bit, the first thing I look to do is to sell a put. That puts it on our list, and then we watch it in the portfolio. If it gets even cheaper, then often is a time that we'll then add the bull call spread, because they say, hey, look, we sold the put, we like the stock, it's coming near the price that we thought it would be at the bottom, and now it's a good time to buy some. You don't do it with high-flying, crazy stocks or anything like that. You do it with slow, steady stocks that pay you dividends. And if you get into that habit, let's say we do 4 of them, and we collect $20,000 over the course of the year. That's 10% of your $200,000 cash, and it's going to tie up about $20,000, about 5% of your buying power. So you use 5% of your buying power. You're going to use 10. You're going to collect 10% of your cash, and all your money's still sitting in your broker account where it is insured. And if it's not insured, by the way, get a different broker. Your broker's accounts are insured too. Now, it's not insured against you losing money on the short puts. If the market crashes and all your stocks go down, you'll have to actually buy those stocks, take the loss, and deal with it. These are for stocks that you actually do want to own for the long term. If the market does drop 20%, you'll be assigned these stocks. But then you say, you know what? That's my portfolio. I got AT&T for a 15% discount. I got McDonald's for a 15% discount. I got Disney for a 15% discount in the great crash of 2018. And from there, you then work on it. And if I am stuck with Disney at $95, and it's not 95 anyway, it's net. You didn't lose money yet. It's net 90 that you're getting assigned for. So if I'm stuck, you didn't make your interest. If you get assigned, obviously it's off because you didn't make your interest, but you didn't lose the money yet. You have the stock at net 90, and if I have Disney at net 90, I turn right around and I sell the $90 calls. Now, again, Disney drops 20%, so let's say the $90 calls would be like the 110 calls. So I sell those for $10 to cover. And my net is already down to 80. So the question isn't whether I want Disney at 107 and I'm going to collect $5. The question is whether I want Disney at net 80 because that's where it's going to get assigned to me. That's $27 below the current price. It's like a 25% discount. That's my worst case, is getting a 25% discount on Disney. And again, if you have $200,000 sitting around, why wouldn't you want to have $80,000 worth of Disney stock in your $400,000 buying power? There's nothing wrong with that. That's a good thing. You know, I mean, I know I know people got burned in 2008 when the market completely crashed, but also what you learned in 2008 though is even if it went down 40% and you're looking like a deep hole, like you have your 200,000 down 20-30%, if you just hang on and you wait, it comes back, especially these blue chips. All right, so that's my very long answer as to what we do with that, as to what we can do for interest in an account. You don't have to mess around with CDs and things like that, or bonds. Bonds I wouldn't touch, because the problem with a bond is a bond that pays you 3% now, right? If rates go up to 4%, let's say you have a 10-year bond that pays 3%. If the 10-year next year goes up to 4%, then nobody wants your 3% bond, because it pays 1% less per year than the current bond, right? So for you to sell that bond, you still get your 3%. If you stick it out and you wait and you don't do anything, that's fine. You're going to still get your 3%. You're not losing money. But if you want to do something with the cash and you try to sell your 3% bond when the new bonds are paying 4%, what the bond people are going to do is they're going to say, you have to make up the difference between the current 4% bond and your 3% bond times the amount of years that we would have to hold it. And how much is that going to be? If it's a 1% difference and you have 9 years left, it's 9% less. They will give you 9% less than the face value of your bond to give it back. So there is no safety in bonds. It's a complete illusion. And people, the rates have been low for so long and such, people have forgotten that this happens. And there are even people who made money, of course, when you have the higher, it goes the other way. If you have a high note bond, if you have a 10% bond and the current bond's at 3%, you can get a premium for selling that bond. So that's what people remember, because rates went from way up to way down. But that's not the situation now. Now you're buying bonds low. It's insane to buy bonds right now. IQ, are you comfortable selling July 30 puts? Are you kidding me? It's miles in the money. No, we did unfortunately sell some IQ things. I forget what it was. Let me see if I got it here. IQ has just gone completely nuts. So in our portfolio review, which I guess I can make bigger, Control++. Control. Oh, too big. Scary. All right. Now let's see if we can find IQ. Control FIQ. We had sold 5 January 2250 calls. We got burned on those. We rolled them to 10. I'm sorry, these were July. We rolled them to 10 January 35 calls, and we sold for 820. That's net 4320. Now, we thought that was pretty smart, but unfortunately, IQ itself is now some horrible number, like 45. IQ. I'm not bearish. Look, 45. I'm not bearish on IQ. And in our position, we have 50 longs and only 10 shorts. It's not like we're not going to be in big trouble on this, because that 50 longs are going to pay us a fortune. But where is it? Where'd it go? Here. We have 50, 25, 40 spreads. Those are going to pay 15 times 50, $75,000. So these pay $50,000 bonus. and we're in at net 43. So for us to lose $50,000 on 10, on 1,000, they have to be $50 over. We have to be at 90 before we start losing money. So we're not really worried about losing money on the short calls because we're 5-to-1 covered. But I'm not shorting in any way, shape, or form IQ. Because we originally had 20 longs and 5 shorts, because we didn't believe at the time, we got stuck selling the 35 calls. Had I known, we would have just done this play and not bothered with anything else. So what we did is, in fact, we actually have, in fact, we have 10. Oh, we have 10 uncovered? No. Roll 20 IQ, 2250 calls. Roll the 15 calls. Roll the 15. Oh, wait. No, I'm sorry. We have 40. Damn it. No, we have more coverage than I thought. I'm sorry. We have 50. We have these 40 plus 10. We have 50 short. We're going to have to actually buy more longs. So I'm not intentionally short. We're at 43.20. I thought it was going to stop at 45, and that's going to be good coverage. Because again, like I said, we have a lot of over coverage. We have 75,000 coming to us, but with only 50 longs, we only have $15 of headroom above 43.20. So whatever that is, 58. So anything above 58, we're back in trouble again, and we'll have to roll everything out again. Below 58, we make money. Above 58, we lose money. That's where we are in this position. So, and I'm not comfortable that we're not going to be above 58 the way this thing is. I mean, Jesus, look at this thing. Is it silly? Who's to say? It's one of those Chinese companies that they could double tomorrow and it'd be just as ridiculous. So we're not going to just let it go. We're going to, well, I'll tell you right now. I mean, the January, what are they, January 35? So if we look at IQ, on the, you don't want to be underhedged either, but if we look at the January 35 calls, they're $20 already. That's crazy. But of course, we use that to our advantage. So what we're probably going to do is spend $5 to roll these calls, the 35s, up to the 50s. And what that does is gives us more headroom. So it puts us out of danger. So if we spend $5 to roll the calls higher, then we don't get in big trouble if the stock keeps going up. And from there, from 1650, let's say, I'm sorry, that's 2020. I apologize. These 35s are 15. So if we roll them to the 45s, those are 11. So it costs us $4 to roll them to the 45s. But then from there, those 11s, because we have a 20-20 spread, so then now you look ahead to say, what's 11 over here? 11 is the 65s. So if we spend $5 now, giving back 5 of the 820 we already collected on the short calls, we then create headroom all the way up to 65. So we have a 50% gain in IQ before we're in trouble again. I'm not saying we're going to do that right away or anything. I'm just saying I'm not uncomfortable where we are because the premiums are so high on this thing. There's ways that we can adjust it. But it's messy, and certainly I don't recommend shorting. Although it seems tempting, it's like I don't recommend selling short calls on it, or only a very small amount compared to your longs, because this stock is crazy. All right, so that was the IQ question. Let's see. Robin says, I took profits and have $200,000. What would you do with the cash? Okay, so again, Robin, what I would do is I would start that plan that we were talking about. You've got 200,000 cash on the side. In fact, I just did a perfect example for where you are. You start by saying, what do you want to own if the market drops 20%? Well, I want to own some AT&T. I want to own Disney. I want to own McDonald's. You want to own some blue chips that are going to come back. So all you have to do is do that. And like I said, you can do that if you are more aggressive, you can do it every month, but I wouldn't do it more than every month. But you pick a stock each month and you say, I want to sell about $5,000 worth of puts. Now make sure though that you actually want the stock, and you don't do it obviously if the market starts turning against you. You don't add to your pain, and in fact you look to take some of them off if it starts turning against you. But as long as the market keeps going up and it keeps going your way, if you sell 5,000 a month, that's 60,000 a year. Okay, that's a lot of money. That's a 30% return on $200,000, and I'm saying that's very aggressive. So not necessarily should do that. But even if you sell 5,000 a quarter, it's 20,000 a year. That's 10%. So somewhere between 10% and 30% returns just from selling puts you can get on your money. So you don't have to do anything crazy. You can just sell the AT&Ts, pick up $5,000 or 6,000, whatever our example was, and wait a month and see if the market still hasn't crashed. You say, wow, what a great market. And then you say, okay, you know what? I don't want to wait till the next quarter. Now I'll sell McDonald's or maybe Walmart, or who knows what's going to be a bargain at the time. But I'm talking about looking at blue chip stocks and saying, who's cheap in the blue chip sector? Who's cheap that's going to always pay me a dividend? It's always a good stock that I can always sell puts and calls against and get more money. And you got to make your list. And we have a watch list. We keep it for our members. It's under the portfolio tab. And of course, obviously, every stock in our portfolio is a watch list if you don't have it. So who is cheap? And if you go actually back again to the portfolios, which is here, right? Okay. And we don't have too many because most of our stocks are working out, but it's not the long-term periods. So here's the long-term portfolio, and exactly what I was saying. This is how we build the long-term portfolio. It's a bunch of short puts. There's like 18 of them in the long-term portfolio, and I forget what the number was, but I think it was like $60,000, $80,000 worth of puts that we've sold. Well, I mean, you can see it here. I mean, it's 5, 10, 15, 25, 30, 40, 55, 60, 70, $80,000. Okay, yeah. So basically, it's about $80,000 worth of short puts that we sold, and we've only been running this portfolio since January. But we're being aggressive, and it's a $500,000 portfolio. We were being aggressive because we felt that we were going to be in trouble if the market took off. So we wanted to have plenty of puts. Plus, don't forget, we also hedge in the short-term portfolio. So if the market does go down, we're going to get cash there to pay for these positions. But nonetheless, notice the amounts: 27, 35, 5, 4, 13, 18, 72, 25. We're always looking to get about 5,000 or so when we're selling. 4 or 5,000 is generally what we're looking for when we sell them. And that's why you can see here, we did BX and Cake on the same day on 1/8, and here's 1/9. That actually, this week in January is right when we started. Here's 2/6 where we got this one for C for 22.50, and on 2/6 we did this Berkshire for 5,000. Then we decided, like, in May, after we had Berkshire here for 5,000, we said, you know what, that's not enough Berkshire. And we decided to sell some more puts in Berkshire at a higher strike because it was just, looked like it wasn't going down. These are not blue chips, but again, because we're running a full strategy and we're protected and so on and so forth. But here's AT&T, here's Whirlpool, here's Signet Healthcare, here's IBM, here's Gilead, here's Facebook, CVS, Canadian Bank, Cheesecake Factory, Berkshire, of course, obviously the bluest of blue chips. We're not risking anything here. Well, we're not taking huge risks. Selling puts against stocks we would really love to own. And so what you do is you say, well, so which are the ones that you screwed up on? Here's Canadian Bank. They're a better buy than they were when we started. We sold the 95 puts for $4. Our net is $91. They're at 88. So we're currently behind. There's a good one to look at to pick up. Not the same put. I'm saying sell the put that fits. Sell the one that's $4 now. Here's IBM is a better price than we started at. Not many are. We've been generally pretty good with our picks, but so Canadian Bank and IBM are the standouts here. Ali, I don't think I would add. Who else? Who's underperforming? And AT&T. AT&T's gone nowhere since we picked it up. And Whirlpool also. Whirlpool's a good one. In fact, they had a nice pop today. So there's 4, and just those guys you can pick up 10,000 there. And actually, I'm sorry, they're more because they're losing. But let's say 10,000 there, and IBM was 6,000, and now it's $7,500. And what was the other one? Was and Canadian Bank. Let's say, like I said, 5,000 more. So you're looking at $20,000 right there. You can go boom today and sell them. So it's a good start. Hey Phil, a nose wash may help. I tried that one. I hate that. The saline thingy. Is that what it is, or something else? Anyway, yeah, it's allergies for me. It's like this time of year is terrible for me, and it's now I got a sore throat too, so it's not good. Brendan says, I missed it. At what price would you short oil again and front month of the roll? No, I'm saying if it goes higher. I don't think it's high right now. Where are we? I'm being hypothetical. I took 250 and ran today. Oil. Here we go. Oh no. So back at well, today we have the contract rollover that put pressure on them. Now it's July 4th, so I'm saying into July 4th, I'm not into shorting them. The only reason we shorted this morning was because there were still a lot of open contracts, and we felt that they would have a pretty poor inventory report. So we had a good reason to short them today. I'm not, into July 4th weekend, though, it's a terrible time to short oil. We actually kind of want to root for it to go much higher into July 4th weekend, and then we can short them. So in 2 weeks, we'll be talking very seriously about shorting oil. But right now, not. In your review, all right, Jal says, in your review of portfolios, GIS and MT got second recommend from you. Please elaborate on new trades. All right, so GIS and MT. Let me see. I mean, I don't remember what I say about things. GIS, good for a new trade. Okay, well, I didn't have much to elaborate on that. I'm just saying that the trade that we entered here, this spread, notice it's negative, so it's minus 50. It's about $750 behind or whatever. So I'm saying I think this spread right here is good for a new trade on GIS. That's not complicated. What was the other one? MT. Same deal. I mean, MT. This is actually a little bit in our favor right now. But did that happen this week? What? MT. No. Well, that's interesting. Okay. Did I say good for a new trade in the same way? I don't know what I said on that one. MT. I'm making the assumption I said that. I didn't say that. In fact, where the heck did I even say? Oh, it's the wrong thing. Control it. MT. Okay. Trade war talk is not good for seal stocks, but I love MT long term, and this too shall pass. They are at the low end of our expected range, so we need to keep an eye on them. That's not I see you're telling me I said something I didn't say. That's why I was looking at it, and I go, I didn't give a second recommendation for MT. I said I like them. It doesn't mean I wanted to buy them right then. Exactly what I thought happened. I mean, we went down since I picked it. I mean, since I talked about it, which was a week ago at least, they've gone down because of the trade stuff. But this is a good dipping opportunity. So if what you're saying is you're taking that a step further and saying, well, here's a dip, don't you want to buy it? I'm saying, yeah, I would. I would take it. And the trade we have is fine. The targets are fine. It's right where it should be. Let's see if we can. So this spread right here, which is the 30-37 spread, stock's at 34 basically, and that's after pulling back. Well, I'm sorry. Was it 34? It's not now. These numbers are all different. So it's got to be a better spread now. But the 30-37 spread and the 30 puts with the stock actually at 32, I love it. And probably now it's in the red and you can get a better price. Oh, you can take a look. Let's see. Is this a long-term portfolio? Yep, 30. Frick. This thing never goes down. Wait, what happened? I broke it. Oh, I see. It wasn't logged in. Maybe that's why it never goes down. I'm like, how can it still be at 30% no matter what happens? 29. All right, there you go, 29%. I was like, damn, that's amazing. MT. This is the long-term portfolio, is it not? Yes. Oh, that pesky alphabet. I can never get that right. There it is. So, all right. So now it's showing like basically it's at the same price we entered it. But I like these targets. I like 37 for a target. I like the $30 puts because I really don't think it's going to go much below 30. You're selling them for $4 anyway, so you're netting in for 26 on the puts, and you're picking up the spread for $3. $3 on a $7 spread. You're only paying, even on the spread by itself, you're only paying $1.30 more in premium over 18 months, and you're completely offsetting that with a put sale. So I like that one a lot. So now I do like it. So your reading that was correct. It's like based on what I said, I do like it today because it went down as I thought it would at the time. But at the time, I did not say I thought it was a good forward trade. And 1020 says that's what he does with cash, which I guess is the thing I was talking about. Sri says, please, rule of thumb to milk premiums out of existing stocks. Walmart. Okay. Rule of thumb. There's not a rule of thumb per se, but top of channel. Blue chip stocks, top of channel. Okay, so Walmart I saw was one of the ones you said, WNT. So as you're saying, when do I sell premium? Sell premium when it's up in the channel. If I think this is low, and it probably is on Walmart, I'm not going to sell a lot of calls here. I want to see something higher in the channel. So we look through all of our stocks in the portfolio, and we say, who's up in their channel? Well, obviously, the guys who have really good gains are up in their channel. So you just look through here and say, who's got big numbers? 69% up. That's a lot. Wow, what? Oh, short calls. That doesn't you know, be careful you got the right thing. Because I was going to say ABX ain't no 69% up. Amgen. Okay, so Amgen's up significantly. Best Buy is over at the high end of our target range. CHK, top of our range. Chipotle blasted. It's not quite the top of our range, but it's near the top of our range. So you look for things that are near the top of your range to see what you want to sell some calls against, and then of course you have to also say, do I have the space? Do I have the capability? Do I have the confidence to sell at this level? So you want to find guys that are definitely at the top of the range where you want to sell some calls, unless you think the market's weak, in which case you're going to be more inclined to sell calls just to cover yourself in case of a disaster. So, and again, the thing is in the OLP, I mean the LTP, if I thought we should be selling calls, I would have. So it's not and I hate to say rule of thumb. I always get worried about people asking for those kind of things, because it's not like always do this, always do that. What do I think Walmart is going to do for the next 3 months? And if I think it's going to be flat, then I'm going to sell. What do I think their next earnings is going to be like? And if I think they're going to be flat, and I think the stock's not going to go anywhere, then I'm going to sell some calls. If I don't think so, if I think they might pop, then why would I sell calls? It's only going to hurt me, or it has the potential to hurt me. But my goal with all the long-term portfolio trades, though, is that as they mature and their cost basis goes way down, then I'm less and less hurt by being called away. So in other words, here's Tenet Healthcare, which I think we decided to cash in. I didn't want to sell the calls because it's going up so crazy, it wasn't worth it, and it captured most of its value that we were expecting to get into 2020. So there's no real reason to have it still open, so we cashed it out. But if I have a stock like this that's that far in the money, where my cost basis is 20 minus 11 minus 7 is what? Is 19. I mean, so my cost basis on the stock is $1,000. So then I'm saying, well, what am I doing here? I've got this totally in the money position that has no chance of hurting me, or almost no chance of hurting me. I'm going to make 30 times 8 is 20. I'm going to get $24,000 back on my $1,000 if I leave it to maturity. And meanwhile, what can I do with 30 Tenet Healthcare? So I look and I say, okay, THC is at 37, and I can sell, not July, it's too soon, 58 days to August. I can sell August 38 calls for $3. That's some real money. I got 30 of these things. So for sure I could sell 5. I could really sell 10 of them. So I could sell 10 August 38 calls for $3. I collect $3,000. Don't forget my position, if it matures, is worth $24,000, and almost all of that is profit. So I've got a $24,000 cap or $23,000 cap where I can, that I could be behind. So 23,000 divided by 1,000 shares at 10 means I have a $23. So Tenet would have to be at $61 before it hurts me. But that's a weird rate. That's a weird expression. Just hurts me means from my base. But the reality is, that's why we're closing it out, though. The reality is I can take 20 out of 24,000. We can take 21 off the table right now. So that's what we're doing. I could play games, but again, I'm saying that's my goal in long-term portfolios, to have to make these kind of choices. Because the thing is, okay, I could take 24,000 off, 21,000 off the table right now and just start a whole new position with something else. Or I could leave my Tenet position as it is now, use it as a cushion, and I can sell $3,000 worth of short calls 10 times between now and the expiration. And that's $30,000. That's actually more money than if I just collect the 24,000 when it expires. I can actually double my collection rate on Tenet. Now, if it was a nice flat stock like AT&T, I would obviously do it, because I'm not worried about it blasting higher and causing all kinds of hassle. But since Tenet has been going up like crazy, I don't feel that comfortable getting into like a call selling game on it. So you have to evaluate each stock and the merits, how much you expect to make versus how much you can make right now. Because if I cash 21,000 now, I expect to make at least 40% over 2 years on $21,000. So for me, cashing $21,000 now means I expect to have $29,000 minimum, or let's say $30,000 by 2020 January. There's no way I'm not going to make 20% with my money. So the question is, what better do I have to do? So not cashing the 21,000 gives me potentially $50,000. That's quite a bit more than 24,000. So I could potentially end up with $50,000. But that's only if everything goes perfectly. You certainly don't assume that. Let's assume that half of the sales go well, half do not, and that they, some cancel out. So maybe 5 sales. So maybe I'll make $15,000 more dollars. So my more realistic number is I'll get my 24,000 max plus another 15 is 39. Versus I know I can turn 21,000 into 30, and if I do well, I can do a lot better than 30. And so then then I have to look at it as a bird in the hand versus two in the bush. I can have 21,000 cash for sure in my pocket, or I can mess around with this position and try to squeeze another 10,000 out of it. And on the whole, I feel better and more flexible with the cash. And only because Tenet has run its course. I haven't got a really strong upside premise on Tenet from here. From where we came in at 20, I had a huge upside premise. But now it's at 40. I'm like, yeah, it's done. It's over. So every position you've got to look at and evaluate it and decide what you want to do going forward. Now, IQ, selling puts, Brian is now saying he's talking about selling puts on IQ. I wouldn't. It can go down as fast as it came up, and that's why I'm kind of comfortable where we are. Like we're heavily covered, and I'm not going to roll it unless I feel like we really have to. I know I can pay $5 to roll it up $10, so that's step number one if we have to. Selling puts, though, you can get so badly burned on selling puts. It's just not that attractive. You know, if it's 44 now and they want $5 for the $25 puts, that should tell you something, okay? It's like it's pretty high premium. A lot of people think you can snap back very badly. So I don't think we did that. We didn't sell puts ourselves. We might have now sold puts. I don't remember what I said to do, but whatever it was. We might have sold some puts just because we have so many calls. No, we didn't. We still didn't sell puts. So that's still a possibility for us to sell puts. But because it's a crazy Chinese company, I wasn't comfortable selling the puts. All right. Joustus had me worried on what? On MT? Okay. Charlie says, oh, Charlie lost the audio. Hopefully he came back and got it back. All right. I think my voice is what you're losing, not the audio. All right. Meanwhile, how the index is doing. Let's see the chart. Ooh, blasting back up. Very nice. Look at these guys. Market is so strong, but China hasn't retaliated yet. People, I was just talking to a friend of mine who happens to have relatives in China and visits there often, and we were just saying, like, China today, as a counter to what Trump did yesterday or 2 days ago, China adjusted their monetary policy. So they basically said, okay, all we have to do is do this little thing and we can boost everything back and wipe out your trade deficit, which is what happened. The Chinese market bounced, and that's why we're so bullish today, is because Chinese markets came back, and everybody thinks it's because, it's not such a bad trade war because China's not worried about it. They're not worried because the government is stepping in and supporting them, okay? That's not their only reaction. This is what my friend and I were talking about. That's not how the Chinese work. Or most Asian countries are like this. They're very patient. And when you attack them, they will defend themselves. But that is only the prelude to a counterstrike. They don't quickly punch back. Trump is a jabber. Trump attacks quickly, strikes without notice, does things suddenly, unexpectedly. He thinks it keeps people off guard. There's a reason there aren't very many Trump properties in the Asian world. It's hard. It's easy for him to screw people who are Easterners. Westerners. It's easy for him to screw people who are Westerners because we think like he does and have the same sort of short time frames for things and whatever. Asian investors tend not to be like that. They tend to be much more long-term focused. Asian government people are like that too. They're more long-term focused. They have 5-year plans, things like that. So, the thing is not, when you expect a quick retaliation and you don't get it, you think it's over, but it's not over. And, we'll see what happens, but I'm expecting I didn't want to say over the weekend, but I expect a reaction from China that will be fairly harsh, because this is about who gets to be the boss. And Trump thinks that just bullying in and pushing people around is going to have everybody bowing down to him. That is not actually how global politics works. So, that, and again, that's why I can't get my head around staying bullish or being bullish about things right now. It's too many moving parts, too many dangerous parts. So I would just suggest being very, very cautious. Ooh, gold's nice. Gold's down to 1270. If we look at the gold chart, where's the gold chart? Gold hasn't been this low in a long time. Look at that. We're looking now. Unfortunately, it was an ugly break below. But here's 1270 held up like in November. Then we had a big fail all the way to 1240. Now, that makes it kind of tough to get into 1270, which was support. We briefly went below, but then you say, you know what, we should throw this at. It's kind of like a spike down that we should throw up. What we really did is consolidated at 1280, went up. Now we're back. We went a little bit below 1280. We'll probably consolidate back there. So I'm going to say that I feel good about adding a gold long here. We'll do that for now. This is something we can do in the next week. So let's go to the active trading chart. We don't talk about that much, so let's take a second there. Futures trading is not complicated at all. You pick your thing, gold, August. No, I'm not gonna say, I mean, I don't know, we'll take the August because it's front month. It's easy to watch. Now, all you do is you can see the bids. This guy's willing to sell for 1270. He's willing to buy for 1269.70. I'll offer right above him. I'll become the top buyer of gold at the spot. I put in my click. See one, that's me. The other guy disappeared. I'm the only one interested in buying right now. Got 4 sellers. Is one of them going to capitulate and buy my gold and let me buy their gold for 1269.80? I know I can get 1270. I know for sure I can get that. But I'd like to get, I'm going to first, since I'm the only one offering, I'm going to wait and see what happens. Nothing. Not a heavily traded thing this time of day. That's because all the Europeans are gone. So anyway, so my bid's in there at 1268, whatever, 1269.80. Sorry. I know I can get a fill at 1270. Oh, here you go. See what happened? These 4 guys who were here all lowered their bid to 1270 to see if I'm willing to come up. And I already said to you, I'll take 1270. I'm not moving because nobody's even joining me yet. I'm still the only one offering at 1268, at 1269.80. Why should I move up when I'm the only one? I'm the only one who's willing to buy at that price. There's 4 of them. Might be one guy with 4 contracts, but I was looking at, I was trying to like make it like, to me it's always like people. I'm always thinking like it's 4 people. It's not always, of course, it's one guy with 4 contracts. That could be this one guy's block. I have, you arbitrarily, you set your contract size. I tend to trade in ones because I'm not professionally trading futures. Oh, there it goes. See that? So it filled. So now he dropped his bids, or these guys dropped down to 1269.80. These guys became revealed. They were below me, way down there. And now they're offering 1269.90. And he moved up a little bit and they moved. It's like a dance. They move back and they move. It's like a cha-cha thing, But the last actual sale was mine at 1269.8. That's the price I set. You know, and it's not much, but it's honestly that little savings there was like $20 on the contracts because $10 per tenth of a cent. Um, that pays for the by saving $20, I've more than paid for the cost of the contracts. So I'm essentially in gold at the price I wanted without any fees. So it's not a little thing, and especially if you ever look at your broker statement, you say I made 500 trades. Think about if you just make an extra $5 per trade or $20 per trade. That's $10,000. So don't poo-poo that stuff. Always get that nickel. You're not being cheap. Nobody's sneering at you. It's not a restaurant. It's not like you're not at Saks asking for a bar, asking for the bargain bin. It's freaking money. Don't pay more than you have to. Every nickel you can squeeze out of every single transaction ends up translating into quite a lot of money by the end of the year. And that goes for like yesterday with the what were we doing yesterday? Tesla, the shorting Tesla. They went the way we thought they would. They sold off all day long. So they opened up high, which was good for us because we got our fills. Since we were shorting, and since we knew it was going to go down, I knew it was going to go down. Then what we do is, because we wanted to do a bear put spread, you buy the long put first, and then if it's going the way you think it's going to go, you wait until the short put gets more expensive. That's not complicated. And also the same goes for the short calls. We sell the short calls first because we're short. If you're short, take the position you want to take aggressively first, and then work into it. If you think strongly it's going to go your way. There's no point in having a outlook on something and then not following it through or not using that outlook to make a better trade entry. Anyway, so we'll see how gold does next week. I'm already up $6. I'm very excited. That'll make up for my $3,500 loss on the Nasdaq. As you know, these always seem to work out in the end, but it's very annoying. Let's add 2 here. 1. Now see, I'm at 73.11 with 9. So as long as I'm $20 over that, or as long as I'm $18 over that, I'm going to move the entire batch up a point, right? So I'm going to be at 73.12, 50. Oh, damn it. So here we go. All right. Wow. So now I'm going to be at 73.12, 50 or more, 73.13 by adding 1 more contract. So I moved the needle up. So my break even is now way up here, 73.13. And hopefully I don't have to do that anymore. But this happens a lot. I say the Wednesday seems to be a very bad day to bet against the Nasdaq, yet I keep doing it. But on the other hand, it's also a very good day to get good fills on the Nasdaq, and I like to have very large short positions for when the retrace happens. And the moment Tesla's bouncing back, a lot of Nasdaq stocks are bouncing back. So we'll see what happens. I feel better about the gold thing than I do about the Nasdaq, but I've only got 1 gold and I've got 10 short Nasdaq, so we'll see. We'll see if it evens out over time. Silver, I like down here, but we've been hitting 1625, so I'd rather start at 1625. Coffee, always a buy below 117. This is KCU8. Brent oil, that's whatever it is. Regular oil, whatever it is. Gasoline, whatever it is. No one cares. Natural gas was a good deal below 290, but now it's, they're going to have trouble. Until we get over 3 solidly and stay there for a couple of days, it's going to be tricky. And that's it. All right. I'm going to stop talking since I'm running out of voice again. I got to do some stuff later, too. Okay, so Charles back good. 3 says, thanks. Even being just a trend watcher, I learned more from you from. Oh wait, I'm going to read this because that's nice. Sri says, thanks very much, Phil. I can unequivocally say, even being just a trend watcher, I learned more from you than anyone else on stocks. Well, thank you. I appreciate that. That's fantastic. 1020 says he's chicken shit. He's talking about Trump, I guess. Blah, blah, blah. We're not going to talk about that. Brendan says, why has silver and gold, why is silver in the Dow, which doesn't make any sense, not reacted to the tariff like you would expect? Look, the Dow did pull back. The Dow's only even for the year. That's not good. The Nasdaq's up quite a bit for the year. The Dow's even. Brendan says, would I buy SI? Yes, I would buy SI, but you can get some incredible pain from SI. It's very dangerous. And gold is dangerous too. So that's, but I like where gold is more than silver at the moment. As to YM, unless you meant YG, look, the Dow hasn't reacted because people aren't taking this stuff seriously yet. Everybody thinks Trump has a plan. This is the funniest thing. I see all these analysts and like, well, Trump is a brilliant strategist, and what he's doing is acting crazy and doing crazy things in order to get his opponents off guard so they'll capitulate because he's so crazy. And that's smart. See? I don't know. Okay. I was in a hotel last week, and I was swimming in the pool, and it was a big pool. It was Harry's, in Atlantic City. And I was swimming in the pool, and it's a great big pool, and everybody's saying basically we're in their spot and whatever, but it's kind of hard to do laps or anything like that. But this one guy is swimming, and I think there's something wrong with him. I think, mentally something is probably wrong with him. He was an adult male, probably about 30, and he's swimming, but he's also talking to himself and mumbling while he's swimming, but everyone's getting out of his way. That's what I thought was funny. Everyone's getting out of his way, and I'm thinking to myself, what a freaking scam. What a great scam that is. If you're willing to do it, and you're willing to sit there and mumble and act crazy, you can just swim and not worry about anybody. Everybody moves away from you. Everybody gets out of your way. You can swim as much as you want, and you have a perfectly nice time, and all you got to do is act crazy. I don't think he was acting, but I just think it occurred to me, it was very funny that that's all you have to do to take over a pool or to take over a lot of things. And that's effectively what people think Trump is doing. They think he's just acting like a lunatic, and that actually he's really clever, and this is a great strategy to get his way. I don't know. I just think he is a lunatic, and I think if he does get his way, it's going to be by accident. But I also think that our status in the world is tumbling. I think that we're burning bridges. I think that we've used up massive amounts of goodwill capital that we built up over the years, and that on the whole, this is a horrible, horrible thing. And I also think that, as I said yesterday in chat, I said, look, if I was China and I was President Xi, I would say, okay, here's what's going to happen. Say, as of June 1st at 12 a.m., 12 a.m., June 1st, China will buy nothing from the United States. Not June 1st, sorry, July 1st. And until July 31st. And we will only start buying things from the United States on August 1st if Donald Trump crawls on his hands and knees across Red Square and kisses my ass. Because you know what? We could never do that because we can't stop our guys from buying things that they want to buy. But China can just say, hey, don't buy any American stuff for a month. And that would be that. And everybody would stop buying American stuff for a month, and our economy would go into a tailspin immediately, and the stock market would drop 10, 15, 20%. And believe me, Donald Trump would be on his hands and knees in freaking Red Square. He'd either have to resign or they'd force him to do it, the business interests in this country. And China would basically just be like, okay, this is what we mean. Don't freaking push us around. And might not be that drastic, but I think we are going to get bitch slapped by China. And we'll just see what happens. But you don't do this. You don't treat, you know, Trump treats China like it's North Korea. Like he can just push them around and curse at them and say things like that, as if they don't care, as if presidency of China is not Trump's equal. As if as if Angela Merkel, who he's freaking criticizing openly. You don't criticize other world leaders, especially when they're your partners. And Trump's openly criticizing her and causing her to have government instability. And what do you think? She's going to be like, oh, he just says things like that. No big deal. No, she's going to get that son of a bitch. She didn't get where she is in German politics, which are ruthless compared to our politics. They got like 5 different parties. They got a bunch, like 10 different parties run for stuff, and 4 or 5 of them get in power, and then they have to make coalitions and things to get. It's a mess. You don't lead for 20 years like that if you're not pretty ruthless. And she's not going to put up with that crap, and none of them are going to put up with that crap. You can't even get even Macron in France. He pissed off the Canadians. He pissed off Trudeau. But those guys, Macron's going to snap back, and Trudeau's going to snap back, and Fox in Venezuela and in Mexico, they're going to snap back, because those are smaller countries, and they don't, for them it's just like they're just got their pride hurt. But for China and for Germany and things like that, you cannot push these people around. They have the power to hurt you. And they're not going to openly come at you. They're going to get you. So we'll see. I mean, I know a lot of you guys saying, oh, no, yes, we're America, blah, blah, blah. That's not how it works. That's not how the world actually is. That's how the world was after World War II. And if you're a 70-year-old guy like Donald Trump, 80-year-old guy, whatever the hell he is, you might think the world's still like that, but it's not. And there's a lot of ways these countries can hurt us in the global economy. So anyway, so that's where that is. And meanwhile, it's a good reason to have gold and silver, because we are in an unstable environment, and it's just like, for some reason people in this country are so unaware of what's going on in the world, and they really do have that obviously we elected Trump. I mean, it's you have that attitude like, America #1, we're the greatest, we can do what we want. It's crazy. It really ignores you. I mean, to treat the rest of the world, the people in the rest of the world, as if they're not as good as you. What do you think that does long term? If you don't think they're as good as you, and our stance on immigration shows we certainly think that certain people are nowhere near as good as us. They don't have the right to come and live a good life. They don't have the right to work. They don't have the right to raise a family. I mean, the same guy who talks about record low unemployment and rising wages and this and that, wouldn't that mean that you want to bring people into the country and fill those positions and have them become homeowners and citizens and so on and so forth? The two things don't go together. We have record low unemployment because he's not letting anybody in. We have record low unemployment because he's kicking people out. That's not a strong economy. That's a demand economy, no better than China. It's a government-run economy. The way he's running it is by kicking people out that creates jobs. Not letting people in creates a demand for American workers. And you say, well, yeah, that's the way things should be. It isn't really, though. You grow an economy by growing an economy. You grow an economy by making the opportunities and having the jobs and having companies grow. So anyway, bottom line is, even though these charts look so spectacular, whatever, I think that they're just ignoring too much crap to jump in on this kind of ride. Okay. Anyway, 1020 says it's a bad format to communicate in real time. Well, yeah, but it's, otherwise what? We're going to have a conversation in a webinar and it's going to bore everybody else? No. This is the best thing for covering topics. Why did you trade YG versus GC? I just like YG. I don't know. There's no particular reason why I trade YG over GC. And there's no reason to trade GC over YG. The YG contracts are smaller, I think, is the thing. And I always forget that because I only buy one and it moves $6. And I go, what? But they're basically the same thing. It's just a question of amounts. How does the NYA look to you? Do you still expect to pull back? I guess I have more fine-tuning control with YG. So how does the NYA look to you? Do you expect to pull back in the indexes this week? Do you think next week? I think there will be a pullback. I think there will be a reaction from China, possibly from Europe too, possibly from Canada too, possibly from any of the 10 people we've pissed off currently. I think there'll be reactions. I think they'll be damaging, and I think people are going to suddenly get worried that this might not go as well as we think it is. Trump said today we're winning the trade wars. He just started them. How do you claim victory the day you start them or the week you start them? People believe it, though. People believe anything this guy says. It's unbelievable. I mean, they never believed anything Obama said, but they believe everything Trump says. So what are you going to do? I mean, it's I was skeptical of things Obama said, but I'm more than skeptical of anything Trump says. In fact, I basically assume anything Trump says is bullshit. And it's not really because I'm a liberal. I am a liberal, but it's because everything Trump says is bullshit. It's because there are thousands and thousands of examples of times he has lied flat out to the people of America. And he's only been president for not even 2 years. I mean, he's had 500 days and I think 3,000 something lies. This is 6 times a day he lies to the American people. Proven. I mean, these are proven lies. The people of magazines and things are following him and saying these are absolutely, definitely lies that he has said. 6 times a day. So the chance of him saying something that's true is actually lower than the chance of him saying something that's bullshit. So what was the question? Oh, do I expect a pullback? That's why. So when the guy says we're winning the trade war, it's not that I doubt it. It's that I don't see how it's even possibly true. And just because the president said it doesn't make it true. Although, unfortunately, there's plenty of people, as Lincoln always said, as Abe Lincoln, the great Republican, said, you can fool some of the people all of the time. And that is Trump's base. All of the time. Not some of the time. You can fool all of the people some of the time. All of them can be fooled some of the time. Some of the people can be fooled all of the time. And you can't fool all the people all the time. That's obvious. But the key is, and Lincoln was right, you can fool some of the people all of the time. And that's what's going on. And that's why the market is doing so well. That's why people are so confident. But eventually they catch on. We will see when. And May says, should I exit the 2020 WPM position soon if you're not bullish on stuff? I'm not bullish. I'm just not currently bullish. I don't see any, because the dollar is very strong. We don't have the dollar up here, do we? Okay. Well, actually, I mean, look, see, the dollar's at 95. And that's about it. I gotta stop soon because I'm gonna lose my voice completely. Let's just look at this. Not you. There. Okay. So currencies. Dollar. April, May, June. 89 to 95. That's 6 into 9 is, I don't even know. What is 6 into 9? 6 divided by 90. 666. Oh, great. So it's 666% dollar rise. I would expect silver to be down 12%. Usually they move double. All right. So same thing, 1360 to 1280 is it's not going to be that much. So the drop from 1360 to 12, not gold, silver, 1720 to 1630 is 90 is I'm sorry is a dollar. Wait, no, 90 cents. So then we go 90 divided by 1720, 5.2. So silver is down less than the dollar is up. And then gold also is down less than the dollar is up. So the entire move in silver is based on the dollar going higher. Now, it doesn't mean the dollar is going to stop going higher. Look at this. But do we think that's warranted? Right now, you've got people panicking into the dollar over trade issues. It's only started a few months ago. So trade issues mostly are driving this thing. Rising wages, though, is a factor. More people getting paid in dollars. Perversely, rising oil prices are actually good for the dollar because almost all the oil in the world is settled in dollars. So the more oil costs, the more dollars are put in circulation and move around. So that's good for the dollar. There's more demand for the dollar. Look, if oil at any given time, there's a 30-day supply, let's say, of oil floating in tankers, right? That's how you got to look at stuff. Here's my calculator. There it is. All right. So it's 100 million barrels, so 30 times 100 million barrels times $60 a barrel is $180 billion of oil. Now, so at any given time, there's 180 billion barrels of oil floating around. Now, if oil goes up 10% or down 10%, you're talking about a demand in a month of $20 billion more dollars when oil goes up. So when the dollar goes up 6%, so now we take $180 billion times 0.06, $10 billion. So that's the additional demand for dollars. All of a sudden, there's a $10 billion additional demand for dollars. And then you look at other facts. You say, well, how many more people are working? And then you say, how much do they get paid? So now let's say we added 1 million jobs. So then 1 million jobs times how much people get paid? I don't even know. What do people earn in this country? Let's say $24 an hour times 40 hours a week is 800. Let's say $800. So $800 times, that's a week, sorry, so it's times 4 for the month. So $3.2 billion. So this is how you do an analysis. So you start thinking about how many dollars are there in circulation, how many dollars were being used at point A, and at point B, how many dollars are being used. So now you say, okay, fine. So these factors cause more dollars to be used, and therefore more demand for the dollar, and that drove the dollar up 6.2%. So now the question is, have we overreacted? Have the speculators caused part of this rise, or was it actually based on more use of the dollar, more demand for dollars? So then you got to look at imports, exports, trade, so on and so forth. You have Trump saying that he's going to balance trade. If we balance trade, then there's more demand for dollars. If you're going to force China to buy $10 billion worth of goods a month that they weren't buying before in U.S. dollars, there's demand for $10 billion more dollars a month. So there's assumptions built into this that what Trump says is true and is going to happen. But all that has to be taken into account, and then you end up saying, well, okay, fine. So this is baked in, and that's baked in. So in other words, these numbers are backwards, and they already happened. Then there's people who believe especially this last week, there's people who believe that Trump, well, let's look at the hourly chart. Then you have the people who believe that Trump is really going to balance trade and cause demand. That's this extra 2 points here. So this
defined as
whoops. Oh shit.
Include.
I hate that. All right. So the stuff we calculated already justified the move to 93. And Trump's promises are taking us to 95. Now the question is, what's going to take us to 96? And if you can't think of anything that's going to take us even higher than that, Trump comes through on all his promises. Trump actually forces China to balance out $450 billion of trade based on tariffs and fines and blah, 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 blah. And all this stuff happens. Now the question, you have to go back and say, okay, but are we going to start hiring? Will that create 1 million more jobs in the United States? No. In fact, the trade war is going to hurt jobs in the United States. Is that going to, are wages going to rise from that? No, not necessarily. So now we don't have an upside catalyst past where we are. Plus, what if it turns out that people are overestimating the effect Trump's going to have on the situation? So now I'm kind of leaning more down than up on the dollar at the 95 line. Not only that, though, but a normal healthy rejection at 95 from a move from 90 should give us a pullback of at least a point to 94 again. So many reasons I think that we're going to pull back. So that means short term, gold and silver should pop, right? The dollar's going to pull back. Gold and silver will go up relative to the dollar. Easy peasy. Also, another reason not to short oil. But that's, all that stuff has to get taken into account when you're doing a fundamental analysis. You have to think of the situation, the dollar, where it's going to be, where it was, what the trade's like, what part of trades are being affected. The pipeline people, in fact, if you look at another thing affecting oil, if Trump has a tax on metal and pipelines are made of metal, they're having trouble building the pipelines for the cost they wanted to build them for, and therefore projects get slowed or stopped, and that then changes the supply dynamics of oil, or actually, more to the point, it changes how much oil they can ship out of the country, because most of the pipelines that are being built now are being built so we can ship even more oil out of the country, and liquefied natural gas as well as trying to get out of the country. So the main goal of these pipelines is to increase the price of oil. And if they are not getting built, that inadvertently knocks the price of oil down. If the price of oil gets knocked down, now things don't happen as far as infrastructure spending in the energy sector. And if that doesn't happen, that causes a lot of other industries to suffer. Boom. So, it's always a moving target. There's always a lot of factors to consider, but you have to consider them. You have to start thinking of all these different things and how they connect to each other. And that's how we arrive at these trades, not just, what do you think? Anyway, all right, so there's something to chew on until next week. And while I still have some voice left, I'm going to sign off for the day. All right, thanks for coming, everybody. And we'll do it again next week. Take care.